All right. Well, that was the late, great BB King last final note there with the inflation blues. So thank you for joining us from your remote location. I'm Andy Arnold, CEO of Centerline Wealth Advisors. We wanted to give you a forum here to give some insight into our internal analysis process and some of the thought leadership that goes on here at Centerline. So this is our second in our series that we like to call Between the Lines. Our goal is to make this concise enough that you won't get bored with a bunch of jargon, but also insightful enough that you'll walk away feeling empowered and maybe even a little entertained, or as entertained by us finance nerds as you possibly can be. So to kick things off, here is our agenda for the presentation today. First up, we're going to give you an intra-quarter flash market update, or how the markets have been performing and what we're seeing out there. Next up, an economic update. How's the underlying economy actually doing on this side of COVID, or where we are in the cycle? And lastly, inflation. It's been all over the news. So what does it mean for you, and how are we looking at it? So with me today is Ben Doninger, our resident CFP. He's our panelist. And so, Ben, what do you think the current rally has done to valuations, and are stocks still a good investment out there in the markets?
Yeah, I think that's a great question because I feel like every day it seems as if the market's going up or you're seeing some kind of news about it's hitting like an all-time high. And so I thought this was kind of a good chart to show as it shows the S&P 500, which is the largest 500 companies in the United States, and its performance going all the way back to 1996. So as you look at the chart, you kind of see, there's two small hills kind of over here at the bottom. Those are the peaks and bottoms of both the dot-com bubble and the Great Recession. And then you see kind of like in the middle of the page where it kind of bottoms out in March of 2009. It then has this long bull market that lasted for 10 years. The market practically went up for the most part until February of 2020. That's when COVID rocked the world and turned everything upside down. It sent the market almost straight down in about 30 days until March 23rd of 2020. And then since then, we've had a very nice rebound and recovery. And so that kind of brings us up here to today. And that kind of goes back to, people saying, hey, does all this make sense? I mean, with the market kind of where it is. Now, there's a lot of fundamental and technical analysis that goes into whether the market is overpriced or not. And, we could really kind of really dive deep into the weeds, but that might get really technical and may not be necessarily the best for some people on here. So
So
if
you
you
saying
want to,
people
we
don't
could
want to stick around for 6 hours this afternoon to hear all of that? Okay.
yeah, we could have just a nice, long, fun technical conversation here, just to really make your eyes like water over and want to fall asleep. So I thought maybe it'd be better big picture to just kind of talk about the pros and cons of what's going on here. So the pros backing this rally are: one, we're still in a bull market. So what that means is a market is going up, and bull markets don't just die of old age or because they hit a certain percentage or anything like that. They ultimately die from a catalyst. COVID, for example, was the catalyst that ended the last bull market. The financial crisis and the banking and subprime mortgages ended the previous one. So there's ultimately
Great
got to be some
recession.
kind of catalyst out there to truly change the course of direction. When we look at like manufacturing, for example, that's coming in really strong right now. Also, there was an infrastructure bill that was just recently passed by the Senate. Infrastructure is a bipartisan issue, and both parties are wanting to do it. They're kind of arguing over where money gets allocated and this and that. But big picture, if that bill does pass, that's going to be a really good thing for the economy. There's another thought too about don't fight the Fed. That means don't fight with the Federal Reserve. They are in a very expansionary mindset. They have low interest rates. They're putting liquidity into the banking system and encouraging banks to lend. So they're very pro-growth. So you kind of, you don't want to fight like the Fed. And then lastly, stocks are being bid up because they're considered to be a potentially good investment during inflationary times. So people might be leaving other investments going into stocks. So that's kind of helped propel this momentum some. So those are the pros backing kind of the recent rally.
And
Now,
of course, there are cons too.
absolutely, yeah, you can't talk about the pros without talking about the cons. So the biggest con is definitely COVID risk. Luckily, the Delta variant hasn't affected the economy as much as maybe some people were thinking, but there's another variant out there called the Mu variant, as well as if there's any other variants out there that could be resistant to the vaccine, whether it's somewhat or fully resistant. Hopefully that didn't happen, but obviously if there is something out there like that, then that could definitely change the course of things. And then I think another big con to be aware of is just, Fed policy error. If the Fed raises interest rates way too soon, or if they end their bond purchasing program too soon, that could be a headwind for stocks. So those are kind of the big pros and cons. So, kind of big picture valuations, they might be a little overstretched, but, ultimately we just kind of need to keep monitoring COVID and how the Fed policy.
It sounds like current conditions have been very favorable for stocks, but what about bonds?
Yeah, bonds are really interesting. This slide right here shows how the 10-year US Treasury has performed, and it goes all the way back to 1958. And so when you look at this chart, you see that there's this blue line that goes across the page. That blue line is what's called the nominal rate. So that's what the Fed is actually paying for interest. And so when we look at today, that nominal rate is 1.31%. So if you were to go to the US Treasury and say, hey, I'll give you $1,000 for a 10-year Treasury yield, they'll say, okay, thank you. We'll take your $1,000. We're going to lock it up for 10 years. But as your compensation, we're going to give you $13 a year for that for 10 years. And so you're like,
10 years.
Yeah, it's like, oh, okay, well, I guess that's something better than nothing. But, so it's like, okay, there's at least that. But when it comes to bonds, one of the biggest threats to bonds is inflation. And what this gray line that's going across the chart as well shows what's called the real rate of return. So what the real rate of return takes the nominal rate and subtracts inflation from it, and then that is what is your real rate. What's left over is your real rate of return. And so when you look at this chart, you kind of take a step back and you see, all right, well, were the areas in the blue and the gray line, where those are close together, that means those are periods of low inflation. And then when you see periods where that blue and the gray line are really far apart, there's a really large gap, that means that was periods of high inflation. So like looking at the 70s, for example, you can tell like there was, 10, 12% inflationary times back then. Luckily, we're not in that today, but what we are is, if we kind of focus back onto where we are today, you'll see the real rate of return is actually, about negative 3%. And so with inflation coming in about 4.25%, that's giving us a negative real rate of return. And so, at the end of the day, I know you're probably thinking to yourself, why would we be investing in a negative interest rate or any kind of negative rate of return? And the answer kind of comes back to, although yields are low with U.S. Treasuries, they still offer a buffer in terms of diversification and from risk assets like stocks. So while they may not necessarily have the highest current bond interest rate, they're still an important diversifier in a portfolio. And so, we still don't want to get away or avoid bonds, even though they're kind of in this, a negative real rate of return environment.
So you're saying stocks can zig and then bonds will zag, and that diversification makes a portfolio stronger, even though right now at this point in the cycle, maybe bonds don't look all that attractive on their own.
Correct. Yes, absolutely. Yeah. And so, Andy, I think we'll kind of turn it to you. When we kind of look at Andy's going to talk about the economics behind everything, because, we know the stock market isn't the economy. But even with concerns of the Delta variant, it feels like things are starting to kind of get back to normal. You're seeing traffic starting to back up, you're seeing restaurants filling up, and vacations are becoming a lot harder to book. So, Andy, I mean, what are your thoughts? Do you think the economy is back to pre-COVID levels?
Well, it's probably a little bit of a mixed bag. And so we wanted to present this slide because I think in a nutshell, it really shows you what's going on. So on the far left there, you can see just in the abstract where the economy was pre-COVID. And so what areas of the economy were we seeing sort of growth in? And right away there you see in February, March, April of 20, kind of these metrics just fell off a cliff. And what we're looking at here, the top line were purchase mortgage applications. So the housing market was strong before COVID. It really trailed off for a few months, and then it came roaring back. And of course, it's still in a positive growth trend right now. And we think that COVID had a big part of that. People were working from home. They decided it was time to maybe upgrade their house if they were going to be spending more time at home. Maybe they needed a home office and didn't have that. So we think that there were a lot of changes that occurred with work environment. And that really spurred a lot of this, in addition to a lot of liquidity in the system, and of course, cheaper mortgage and interest rates. Next, you see in the purple there, consumer debit and credit card transactions, and these were positive. Of course, COVID rolled in and people just didn't know what to do. They pulled back, they sat at home, probably spent money on pay-per-view and Netflix, but they really weren't making many purchases until they realized, well, maybe I can shift my purchasing behavior online. So rather than go into the grocery, we could do click lists or order things from other providers online. So people really figured out how to do that. And you saw those come back. And of course, now that's the highest line there on the far right. And that's probably been driven a lot by the stimulus in the system, the child tax credits, some of the unemployment payments. You have people that maybe are still out of work, haven't come back, but yet money's still flowing into the household. Now they have time. Let's look online and figure out what we could purchase either to entertain ourselves, or we just have time to do that now where we didn't so much when we were working full time. So I think a lot of factors are driving that number back up. In the green, the light green, hotel occupancy just fell off a cliff. It's been trending its way back up, but still down almost 10% from where it was pre-COVID. The travel and navigation app usage. So these are people that are on the road looking for things. So trying to get to a destination or trying to find things as they're out and about, dropped off 82% at the start of COVID. That's actually up 10%. I think that speaks to, Ben, your point that it's hard to book a vacation now because everything is booked. And so you're driving somewhere and have to try to find something, or you're sitting at home trying to book a vacation and find out where you can go. Seated diners in the US, I mean, it dropped 100%. Every restaurant in the country basically shut its doors and is still 12% below where it was. And of course, TSA traffic, so all the air traffic fell off 96%. It's still down 25% from its peak. Although we're seeing places over holidays where it bounces kind of back to the full output that it had before, and then trails back. So I guess that's kind of where we were and where we are now. I think it's kind of a mixed bag, generally headed in the right direction. Will it stay? We think it's back to what happens with COVID. You mentioned the variants. We don't know what's going to happen on that front. Really, we think that if you look at the science, the key is kind of vaccinations across the country. If vaccination rates go up, then this probably tails off in future months and we get back to something close to normal. But just as you were talking about, even another variant doesn't have to happen. If kids are going back to school and they start getting sick at school and schools close, then parents can't go back to work, or they're trying to work from home. It could be just a real mess. So I think we're going to have to wait and see. Really, the virus and the vaccination rates are going to determine what happens next here.
Yeah, definitely all good points there for sure.
So let's pivot now to the topic at hand, inflation and how it might impact investments. So this is on people's minds. It's on the news every time I look at it. We get questions about this, and so maybe let's just jump into this and see where we go.
Yeah. So
Ben, what is inflation?
yeah, fantastic. Yeah, great question, right? Yeah, if we're going to talk about inflation, first you got to figure out what you're talking about. Um, so inflation is the decline of purchasing power for goods and services in an economy over time. This is a chart that shows U.S. inflation going all the way back to 1971, so kind of like the last 50 years. There's two lines that are going across. One's light blue and one's gray because they represent different parts of inflation, and that's because as finance and economists, we can't make things easy. We got to make things as complex as possible. So there's two different factors on this to talk about. The light blue line is called headline inflation. Headline inflation includes all aspects of the economy and that experience inflation and is more closely related to the cost of living. The gray line is called core inflation. Core inflation removes food and energy from that basket. And the reason why is because food can be affected by external sources such as like the environment. So think of like drought or climate change. Energy can also be affected by external sources such as war or OPEC, which is like a group of countries that produce like most of the world's oil. Last year as a response, response to COVID, OPEC reduced the amount of oil produced by 10 million barrels per day, and that caused a big rise in gasoline prices. They've since started adding back to it, but we're still short like 6 million barrels of oil a day from where we were pre-COVID. And so, when we talk about what inflation's really kind of done more in the recent years, because, back in the 70s, as I mentioned earlier, you had COVID around 12, 15%, or inflation around 12, 15%, but really just kind of more focusing on more recent times. So let's just kind of look at 2011 and to today. You see both the blue and gray lines were kind of, relatively similar, right around 2% roughly, and kind of stayed there apart from a couple little bumps here and there. And then all of a sudden, just over the last 12 months, both the lines have gotten to over 4 to 5%. And so you sit here and scratching your head probably going, so what's causing this? Like what's causing both of the inflation metrics to rise so high? Things that are affecting current inflation are used cars. In fact, used cars count for over 1/3 of the increase of inflation.
Wow.
Gasoline and fuel is another big one. Kind of talking about the OPEC reducing oil supply, as well as transportation services. So think about like vehicle maintenance, airline fares, car insurance. Most car insurance companies reduced their premiums last year because no one was driving. Well, now they're raising their premiums back to where they were, so that's just an increase just right there.
And we had heard that a number of the car rental companies were selling off their fleet just to stay alive when COVID hit. Now they're out in the marketplace trying to buy new cars because demand has spiked again. So that sounds like a very difficult business to try to, guesstimate supply and demand. And so maybe, all those cars were purchased at cheaper prices a year and a half ago. And of course, new cars with the chip constraints, they can't even get new cars out the door. So that maybe explains why used car prices have spiked the way that they have.
Yeah, I was reading an article saying basically this is the first time in history, because it used to be if you bought a car, you take it off the lot, you lose 20% right there. Well, now the adage is, well, you could actually buy that car and then go turn around and sell it to someone and actually make a profit on it. So,
Wow.
It's just kind of a crazy time we're in right now with the cars. All these kind of different things, though, have added ultimately to increase inflation. The big thing, though, is that we think a lot of these are more flexible prices, and they're not really going to stick around long term. Definitely in the short term for sure, but long term, not really seeing these kind of stick around. However, other expenses that like education or communication services, rent, increased wages, now those are much stickier and those tend to stick around for much longer time periods.
So if they go up, they tend to stay up and not come back down when supply constraints go away.
Correct. Yes. Yeah. So, kind of big picture thoughts are, we don't expect current levels of inflation to be sustainable over the long term, as they're still being driven by significant price increases in a smaller number of categories. That said, a clear risk to this scenario is that a resurgence of the virus causes portions of the economy to shut down again, and then policymakers have to unleash another round of stimulus. This simply would unleash another round, or yeah, simply unleash another, sorry, uh, would shut down the economy again and policymakers to unleash another round of stimulus. This will simply prolong the imbalance between stimulus-induced demand and COVID-restricted supply, likely causing inflation to be more persistent. So mouthful again. So ultimately, yeah, inflation we see likely remained elevated through not just the end of this year, but the end of next year, and then after that, ultimately get back to its long-term 2% Fed target. So, a lot of people are probably wondering, all right, so what does inflation then ultimately do to my savings? So I think this is a really great chart because it shows, let's say if you had $100,000 in your savings account and you were just invested in an average money market, how does that kind of compare with inflation kind of over the years? And this chart goes all the way back to 1996. And so what it does is, so if you see over here on the left side, any time that there is a gray bar, where that gray bar peaks, that is the income that $100,000 generated in your average money market account. So on that gray line, you'll also see there's this little blue bar on there. That blue bar is the income needed to beat inflation for that specific year. So when you kind of look at, through the 90s, the income generated from money market accounts look good. You're able to not only maintain your principal, but you're also able to get some income and beat inflation through that. So it's like, hey, that's all good. That kind of makes everyone happy. Well, if we fast forward to today, if you have that same $100,000 and you're investing in just your average money market, the current income generated on that is about $80 for a year. So
you're telling me that 20 years ago, and I remember this, so I must be getting old, but if I opened a brokerage account, it came with a money market and usually a checkbook. And if I put $100,000 in cash, I would earn $6,000 a year. That same setup today, I'd only earn $80 for the entire year.
Yes, unfortunately.
Okay.
And so, but then as we talked earlier, inflation is running like 4.5%. So as you see on the up here on this blue bar, that's the amount of income you would need just to match inflation for this year. So there's obviously a huge gap between the current income generated and the income needed to beat inflation.
So again, back 21 years ago, if I earned $6,000 on my money market account, I only needed to earn $2,500 to beat inflation. So anything over that was just gravy and sort of a low risk, easy return method. Today, it's the opposite. I only earn $80. I've actually lost almost $4,400 in purchasing power on that 100,000.
Right. Yeah,
so that's an actual loss when you think about what can that 100,000 buy me next year that it could buy me this year.
Yeah. No, absolutely. And and in 1 year, it might not be that big of a deal because a lot of times when we think about a money market, it's like, hey, this is more about you got a short-term goal that you're planning for, or just more of like, hey, it's your rainy day fund just to cover so many months of expenses. And so, you kind of weigh the pros and cons. Okay, what's more important, the stability of this money or the fact that I'm beating inflation? And
so what I think I hear you saying is if somebody has 3 to 6 months worth of living expenses in cash with this arrangement, maybe don't get so nervous about that because you need to keep some safe liquid money around. It's just if you're maybe beyond that 3 to 6 months, maybe 9 months, depending on your circumstances, that you're running the inflation risk.
Yep, absolutely. Yeah, you nailed it. Yeah, just kind of the point being, yeah, in 1 year, that's probably not that big of a deal. But when we kind of look at this chart and you go, basically, you kind of follow it all the way back year by year, all the way to 2009, you see that from 2009 to now, none of those years of income beat the income needed to beat inflation. And so you kind of have this compounding effect that you're constantly losing out to inflation. And so if you have any money in money markets that's more for long-term savings goals, that could be, unfortunately, I don't want to say, but it's a very bad thing just because you're basically getting a negative rate of return on your investments, even though the stability of the account, it still looks the same, maybe a little bit of interest is put in, but your purchasing power is eroding constantly over time.
Yeah.
And so, it probably makes you think, okay, well, inflation affects, is inflation basically always the same? And the answer is no. There's good years, there's high inflation, there's periods of low inflation. And so inflation affects investments differently depending on the inflationary environment we are in. So as the inflationary environment changes, we have to adjust the portfolios to opportunities and threats as they present themselves. This is a very complex slide and could probably have at least 30 minutes alone spent on it. So for the sake of simplicity and time, maybe let's just take a look at where we are at today. So we know what this chart shows is there's two charts here. And both charts show the average annual performance of how different investments react when we have inflation that is higher than 2.5%. So the chart on the left shows average inflation or average annual performance of each of these different investments with inflation over 2.5% and inflation continuing to rise. The chart on the right shows the same thing, except it shows inflation falling. So it's kind of two different environments. And so ultimately, we know that we're above 2.5%. We talked about it being about 4 to 4.5% inflation. So we know we're above that 2.5. But now the $1 million question is inflation going to continue rising? Is it going to flatten out? Or is inflation going to fall? That's ultimately the $1 million question. And unfortunately, our crystal ball is broken. We don't know where ultimately it will go. But what we do is we look for common themes. And we try to mark trends and try to get an idea of things. And so where areas like this chart help us is we kind of say, all right, first, let's look at some commonalities. Let's try to say, all right, what does well in both environments? And so the first thing that should kind of jump out at you is, well, this emerging market equity in both environments tends to perform really well. So emerging market equity, that's your Brazil, Russia, India, China, those types of countries that are growing. They tend to perform pretty well in this environment. So we would we'd look at this and go, all right, let's make our little notes, and we're going to maybe do a deeper dive into these areas and see if there's a lot of opportunity there. Other areas that tend to do well are just stocks in general, whether it's small cap, whether it's large cap, whether it's growth, whether it's value. Stocks in general in both of these environments tend to do pretty well. And so kind of going back to the original slide of just, investors flocking to stocks just because they tend to do well in inflationary environments. It's just kind of part of it. So these are ways that kind of give us an idea of, okay, what kind of does well? Well, then we'll also want to look at it and say, all right, well, are there any risks? Are there any things that constantly maybe don't do as well? Are there things that maybe do well in some and not well in others? And then that's kind of where commodities kind of show their face. In the chart on the left, in the high and rising inflation, commodities are up 12%. But in the chart on the right of high and falling inflation, commodities only return on average 2%. And so it kind of gives you an idea, okay, well, where do you really think we are? Do you think we're going to keep going up? If you're right, then, you get rewarded. If you're wrong, then, it's not a negative return, but it's obviously not.
You suffer.
Yeah, but you don't, yeah, right. So you just kind of minimize your gains. So kind of like at the end of the day, though, kind of as I mentioned, all we can really kind of do is follow the data, watch for emerging trends, track consumer behavior. And while we believe prices are temporary, we're not married to that forecast. We're just going to have to keep monitoring it. This is why we recommend ultimately always sticking to a diversified portfolio to help weather any market downturns, and to look to your financial plan to see if your investments have you on track to ultimately meet your goals.
Yeah. So take some of the guesswork out of it. And you're not trying to, if I put too much in commodities and inflation doesn't show up, I'm kind of stranded in that one asset class. Yeah. Makes sense.
Mm-hmm. Yeah. So, the kind of wraps up the presentation we have for you. We've got our nice little fun disclosure pages, and then
That's right.
Yeah, are always fun disclosure pages. So, obviously if you have any questions, there is a Q&A in there that you are more than welcome to send to us, and we'll be more than happy to help answer. As well as, you can always send us a question afterwards or give us a call, and we can always go in more in depth about anything that we talked about today, or if any new questions kind of come up.
Okay, so if anyone has questions, they can type those in right there on their questions area of the screen, and we'll do our best to answer those. So while we're waiting for some to come in, before we get to those, Ben, I have a question for you. Did you happen to hear that Tom Brady's running for president?
No, I haven't.
Well, his platform is going to be on lowering inflation. There you go. So here's a question. Ben, I'll let you take this one. How is inflation actually calculated? We see those numbers on the charts there, but how does it actually get calculated?
Yeah, great question, right? Yeah, if we're talking about inflation, you got to kind of figure out, all right, how do they even calculate this? The Bureau of Labor Statistics basically conducts like a survey that says, all right, what are normal types of goods and services people buy? And basically they then bundle these goods and services into this unit, and they say, all right, well, how much do those cost today? And then let's compare them to 12 months ago, and what was the price cost then? And so if the price cost more today than it did a year ago, well, there's your increase in inflation. So that's ultimately how inflation is calculated.
Sounds pretty simple, really, when you boil it down like that. It's not some complicated voodoo witchcraft that the Fed's dreaming up. They're just actually going out and measuring prices.
Yeah, basically.
Okay, that's good. Here's the next question. If inflation does get worse, is that bad for bonds? And what does that mean? So I think here what the question is getting at is if inflation goes up, then does the Fed increase interest rates? And if rates go up, typically that's bad for bonds. Yeah, in the short run, that's true. Bond prices fall when interest rates go up because new bonds print at higher coupons, which means you earn more interest on new bonds. So your older bonds then are worth less if you tried to sell them. But, you typically have bonds in the portfolio, going back to what you were saying earlier, Ben, as to act as a counterballast to the money that you have in stocks in the stock market that you're trying to grow over the long term. So you want that ballast in there so that if we do see big drawdowns in stocks like we saw when COVID came in, as we rebalance the portfolios, we're then pulling money from those safer reserves and bonds, and we're buying stocks when they're way down. Because it's hard. When there's a disruption in the financial markets and our economy, it's hard to step up and say, okay, I'm going to commit safe money or new money to stocks. It just doesn't feel good. You think it's going to get worse. But that, looking back in history, oftentimes tends to be the best time to commit new funds. And by having bonds in the portfolio, it gives us that reserve, that dry powder that we can then siphon some of that money off and go in and buy stocks. And the reverse happens too. When the markets are at all-time highs, stocks are way up, that rebalance skims some of those gains off of stocks and puts them in a safer area like bonds to wait for a better day to reinvest money in stocks. It's not timing the market, it's just keeping a balance. And ultimately, as you said earlier, this goes back to your financial plan. Do you have a portfolio that allows you to achieve your long-range life goals? And so it's not about, taking any amount of, I'll take a maximum amount of risk to try to earn the maximum return. Yeah, you might, and you might die with more money. Or if you take too much risk and we have a very protracted period of declines, then you could run out of resources. So we want to try to balance those two extremes. And part of the reason we named the firm Centerline, we believe in going right down the middle of the center line, not being too aggressive or too conservative, but having practical solutions that most people need to get them to where they need to go. Okay, so far that's it. Any other questions before we wrap up? No, I don't see any. So, all right, with that, thank you all very much for joining us today, and we'll look forward to seeing you on our next episode of Between the Lines. Have a great afternoon. Thank you.
Have a good one.